All right, fantastic. Looks like pause is blinking. Pause. Well, I didn't, wait. I didn't hear the disclaimer, no biggie. Greg says, looks like pause is blinking. What the hell are you guys talking about? Is it off now? Well, no one's gonna answer that. Is it? Probably gonna talk to it. Why can't I type here? I can't type in this box? Damn it. Call Greg Petro.
Calling Greg Petro.
Hey, what's going on?
I didn't hear no sound from your computer, so I don't know if the volume's not up or whatever.
Oh, am I audible? Can people hear me?
Yeah, we can hear you just fine. Just can't hear the computer.
Okay. That's weird.
But I think when the guy was talking about the pause blinking, while it was playing, the pause symbol at the top was blinking on our screen, but that doesn't mean anything.
No, maybe it does. Maybe like for some reason on this new computer, it cuts off the thing. We gotta look into that. Because the old one just played. The old one didn't care. But this one being more sophisticated may like think that I didn't want to play that through the thing. All right. Anyway, so you all read the disclaimer, says Screw. We're gonna move ahead.
Yeah.
All right. Thanks, Greg. Bye.
All right. Talk to you later. Bye.
All right. So that's it. I tried to type in this box to say something, but I can't do that apparently. I didn't know that. Anyway, markets. Do we want to know what we want to talk about the markets, not about whether or not the stupid thing works? All right, I put that away. You guys can't see it, but there's boxes all over the place when I'm running this webinar that I have to hide, including your questions, which take up a lot of space. Where are we? So let's look it up. This one fin. No. There, futures. Okay, how's everybody looking? Up and up the market goes. Where she stops, no one knows. 25,200 we just hit. I have been shorting since 25,150. My average is, where is my average? 25,150. So yeah, basically 25,150. So I've got 8 short on the Dow. I'm gonna go back. I don't want to go back to like 4 or 5 short though when we get back to even. I just think this is old bullshit. So, we'll see what happens. I certainly wouldn't say it's a strong conviction trade. It's really dangerous the way this market is behaving. It's crazy. But that's where that sits at the moment. More useful, I want to go over the portfolios that we can because we're doing Money Talk tonight. That's right. I'm going to be on BNN Money Talk, which is like Canadian Bloomberg. That's going to be BNN. Oh, Money Talk. It just says BNN Bloomberg Canada. Anyway, so put it on now, but this is them. So we'll be on the show tonight at 7 o'clock, and I think I got 2 segments of this show. I usually have 3, so I'm very upset. Somebody important is on apparently. It's crazy. I get the whole show sometimes. That's funny as by itself. Anyway, so we're going to be talking about the Money Talk portfolio, which I just went over, and I put it out as top trade alert yesterday. So I'll give you a little preview of what we're going to discuss with the good people of Canada. And let me see if I can make that a bit bigger for you. There you go. That was easy. So, we're waiting. The Fed beige book will be out at 2 o'clock, so we'll see what that is. Obviously, I don't anticipate anything great out of the beige book. As I said this morning, Powell's testimony yesterday and today There's nothing there. He's just saying whatever people think they want to hear, they hear, because he says so many different things that you have no idea what he actually said. There's no, the guy can't get up there and say, we're going to hike rates 2 times unless this happens, or if this happens, we'll hike rates 3 times. And we're going to do it in this meeting and that meeting and that meeting. That would be the way. I don't understand why that's worse. I really don't. If you tell people what you're going to do, first of all, you get the more gradual effect. People can ease into what they expect. And if you do what you say you're going to do, then people don't have to go, the market doesn't have to go all over the place wondering what you're going to do. That's just my theory. Of course, I can't run the Fed because I didn't come through Goldman Sachs. Let's see. Money talk, right? Okay, so back to money talk. So we're getting the beige book soon. So what's the beige book going to say? The beige book's going to say, it's going to show a slowdown. It's not going to show incredible pickup. Last time was a very good beige book for May. This one is going to be a little bit slower, I believe. And it's going to show obviously labor conditions very tight. Wages are rising, so on and so forth. There's nothing that's particularly going to be gangbusters for the market that I can think of. We'll see when we put it out. And these beige books suck now. They really ruined them. They used to be big, useful things, and they changed the format. And now it's like barely readable. It's very annoying. Because I used to really enjoy when the beige book comes out. Now I'm like, beige book. Let's see, money talk. So sadly, we can only touch this portfolio when I'm on the show, which is only about once a quarter. And I even said sadly here. So we peaked out at $92,000, which is crazy for a $50,000 portfolio. But now we're down to $84,000 because, things changed a little bit, mostly due to LB's limited brands pullback. And obviously we lose money on the SQQs, but that's normal. So we're supposed to do that. ABX also bad, GE also bad. So we have a couple of bad ones in here that are dragging things down. So I'm looking to raise cash. That's true in the options opportunity. We'll go over that as well. Very quickly, we had ALK, and we expect to make $3,700 more on that one. And that's very simply when it expires. Right now it's $37.25 negative, and when it expires worthless, it'll be 0, and we'll make $37.25. Not complicated. IMAX. Did I talk about these things twice? GELB, WPM. No. Oh, we don't have IMAX anymore. That's why. Okay, we just have the bull call spread in IMAX. So it hasn't gone down. We didn't sell the puts yet. Now, IMAX we decided to cash in because it's not worth holding on to. SQQ, what are we doing? Oh, we're selling the 16 calls. We bought it, now we can sell. So our cost of insurance is $12.80, not too terrible. Okay, I guess we sold the 16 calls. We're leaving the short 23s to expire, and we're setting up a June hedge. So that's a few moves in that one. In Apple, we're taking that off the table. That made a lot of money. Here's the thing. Okay, so there's a good example. So Apple, we took this trade back in September. It was one of our first trades in the portfolio. And it's a 150, 165 spread with a 140 short puts, and the net was 50 minus 35 is 15 minus 9, about $6,000 we spent for this trade, 6,000 cash. At this point, and the best you're going to do is going to be 20 times 15 is $30,000. That's your best shot, is $30,000. So currently, it's at $25,300. So we're just taking it off the table. There's no point. The 140 puts it down to 70, so there's really no point in waiting 2 years. From 2020, we're not going to wait 2 years to get 70 more cents because it does tie up margin. So why should we use it? clearly, we can do a lot better than making 20% more money on $25,300. So I'm taking this huge position off the table, dropping it to cash. It leaves us flexible into earnings season when they throw bargains at you right and left. So that's why we're doing this. Doesn't make sense. After earnings, first of all, after earnings will be closer to the end of the summer, and we'll have a better idea of where everything stands. We'll know what the Trump indictments are looking like and so on and so forth. And we'll know how the trade wars are shaping up. We'll have so much more information to trade with in 6 more weeks that going to cash now is very, very sensible. We're not, even if we miss something, it doesn't matter, because it's like, look, we made 60% here or 70% here. Yeah, 70%. We made 70% here in 9 months. Not running around being desperate to trade or anything like that. We didn't even like the market most of the time. A lot of these trades, and I'll show you on the next portfolio especially, some of these trades make so much money when they work that all you have to really do is pick a good time to trade. You don't have to be catching a market wave. That's for all the suckers, okay? They have to run and catch a wave. It's like everyone else has to go out and surf and make a wave, but we have a pool that makes waves. We have one of those things that automatically makes waves. The waves might not be as big and they might not be as exciting, but they are freaking consistent, and we can do it all the time. We don't need to time the market. When it's not certain, when it seems a little toppy, we just get out. That's what we do. So ABX is down with gold, and it's getting silly at this price. They had a report. I didn't write it here. I'll show you later, though. There's a gold report for them. It's got $11,300 left to gain in the spread. It's a nice spread. I like it. GE, good for $12,655. LB, good for $11,000. In fact, I'm going to be saying about ABX and LB on Money Talk today. I'm going to say these are the 2 trades I recommend from scratch right now as brand new trades. But Wheaton Precious Metals is, let's cash in our 50 January 17th and buy 30 of the buy. We're changing the nature of that spread to be a bit more bearish. So in other words, what we're doing is we're cashing in our successful long calls. We have 50 January 17 calls down here, super deep in the money. We're taking that money and running. And what we're doing is we're going to buy 30, 2020, 2250, which is where it is right about here, 2250, 30 bull call spreads for very little money. So out of 25.5 we cash, we're spending 5,000. So we're going to take 20,000 off the table. And those 30 spreads now are going to protect the remaining short calls that we're leaving naked. The January 22 calls. Now, what's our worst case? Our worst case is if Wheaton Precious Metal starts taking off again, what we're going to do is buy more longs, and we'll buy more long spreads as it takes off. So I'm not worried about that. That'll be a good use of our cash. This spread is only $5,550, and it's a 7 times 30 is the $21,000 spread, $2,250 actually. So I mean, why would I not want to buy more of those? If it goes to 7,000, I'll still buy it. It's still going to make a triple. So if we go to 60, that'll be well covering the 50 short calls, and we can take the 50 short calls off the table, and we can roll the 50 short calls, and we can sell some puts. There's a million things we can do that made me very comfortable taking $25,000 or $20,000 profit off the table on the spread. I still have a huge upside on the spread, but I'm taking $20,000 off right now and putting it back in our pocket. So I'm saying here we have $54,000 worth of trades, winning positions, and the remaining trades have $38,000 of upside potential, which is 77% of our original $50,000. So we're cashing out $50,000, which was our entire original amount that we put in, and the remaining, and we still have the gain. In other words, it doesn't change the fact that we still have sorry, I'm still going to use my new computer. it doesn't change the fact that we still have $84,000. We're just turning 50,000 of it to cash. You see this total market value, 49,000. We're actually cashing in all of the winning positions, and we're going to leave. We'll have a negative market value and a ton of cash. We'll have 84,000 in cash and basically no market value left. But we then have, in addition to the $84,000, almost all cash that we have a 30. What happened here? Oh, that's a new trade. That's why. Sorry, I got mixed up. We have a, where did I put it? Oh, we have a $38,000 upside. So that'll be 84 plus 38 is 92, 122. So we're looking at being at $122,000 at the end of next year from a $50,000 start. And we're being cautious and cashing things out, and we've only got a couple of open positions left. That's how you play a portfolio, though. Enjoy the money. Don't constantly put the money back at risk. Take it off the table, hold on to it, be the guy sitting there with the cash, and people will offer you money. I'm sorry, people will offer you positions. For example, in PSW investments, we do deals, but we don't do a lot of deals, but people constantly come to us to make deals, our investment arm. And it's interesting because it's like, I understand why angel investors like to poke around but never actually play anything, because people just keep coming to you and coming to you and coming to you with different deals. And all you have to do is wait for the right one to come along. You don't have to jump on the first thing that's offered to you. You will constantly get offered. If you are the guy sitting there with cash to spend, you will always have offers to make. Not in this portfolio because it wasn't on the thing, but in the option opportunity portfolio, like Walgreens Boots. Walgreens Boots made a negative announcement a couple of weeks ago. The stock went flying down. We were like, oh, that's stupid, and we bought it. And now it's already up like a huge amount. That happens every day. It happens, not every day, at least once a week, though, something like that happens, but only if you have cash to spend. If all your money's tied up in a portfolio, no matter how good that portfolio is doing, you're missing opportunities. You got to have a balance. You got to have some money to deploy. And when you do have a lot, like in this portfolio, is doing great. 70% is very good, but I still wanted to go through it and say which ones aren't as good. And so here we said, here's a new play on General Mills. Why do I like General Mills? Not to go over the whole thing. I like General Mills because it's freaking General Mills. Bisquick, wait, I'm pointing my finger, that's stupid. Bisquick, Cheerios, Coca-Cola, blah, blah, not Coca-Cola, Cocoa Puffs, Go-Gurt, Haagen-Dazs, blah, blah, blah. It's all famous, big, huge brands that everybody uses. They don't really have to advertise. Right? You're not going to not buy Pillsbury because nobody mentioned them on TV this week. So it's a constant business with constant things. The problem is they bought a pet food company and people didn't like it and the stock plunged. And in fact, even today, it's actually down another 2%. I think it's a fantastic bargain down here. So it's a good time to pick them up. It really is. We're bottom fishing. It might come back down to 42. That's not critical. It's not. We don't really care. We're buying the 40, 47.50 split. 47.50 is here. That's all we're planning for in the next 18 months is for it to get back to here. And it's a good, solid company. We'll find out at earnings what happens, but we'll see how it goes. All right, questions on this. Let's see. Dun, 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 dun. Nobody's saying anything. Wait, what? Okay. Brendan says, do you still like CL short at 67.50? No, we don't actually. We kind of stopped playing it. I said that yesterday. I still think it's going to go lower, but not enough to really get heavy. I'm not really looking at that. You need a catalyst. And it's so much trickier to have a good catalyst when it's going up and down in the channel. Okay, so in other words, when something's at the top of a channel, it's easy to short. when something is not at the top of a channel, it's not easy to short. This is very not complicated concept, right? So oil, go to days, all right? When oil was 75, and even if you extrapolate this line out, it's really kind of the top of the channel. And I was very, very confident calling a short on oil here. Plus, we knew it was jacked up for the holiday. This was very bullshitty sort of gains here. So it went from 65, which was probably barely the right number, to 75, and I thought that was all bullshit. So I think it should go back to 65 now that we've done with the summer driving season. I think it could go lower than 65, but it's not an easy bet anymore. It was an easy bet. In fact, we cashed in on STOs today. It's not an easy bet because you're low in the channel and there's going to be buyers. There are going to be people who look at this line along the bottom and say, oh, oil should be at least 70, I'm going to buy because technically that's the channel. And that's a lot of people to fight because most traders are technical traders. So you can't really ignore that, and you need a catalyst to bet against it. The catalyst, there were a lot of bullish catalysts, like there was a strike in the North Sea that took production offline. We had this boycott bullshit with Iran. We were trying to get our allies not to buy Iran oil either. Iran oil. Libyan production was offline. All these things have started to like address themselves. OPEC was, who knew what they were going to do? It turns out they're pumping more oil now. Our rig counts are going up, so we're pumping more oil also. Demand isn't playing out to be a big story. It's been disappointing. So all those were the things that were trying to sustain $75 oil. It was very easy to bet against that because I knew it was going to collapse, because with all those things in the news and with all that stuff being pushed in the bullish picture, we were only at 75. So I said, on July 3rd, you can read my July 3rd post. I said, look, that's a lot of catalysts, and all we're at is 75, and it's July 4th holiday. And after this holiday, what are the catalysts going to be? Where's your demand? You know, the demand catalyst is gone after July 4th. The next one is the next holiday is Memorial Day or whatever it is we do in September, Labor Day, whatever one that is. That's our next big holiday. And after that, then you're in the real doldrums because there's no vacations, there's no driving, there's no nothing going on in September. There's no pools to heat, there's no air conditioning, there's no heating. It's a tough time for energy producers to make money. So that's the next big time to short. It's going to be after any kind of rebound from here. But we were hoping to 65. I still think we'll hit 65, but we got to 67.50 really fast, so we took the money off the table. That's fine. I don't need to play anymore. Let's move on. And in fact, speaking of moving on, look at coffee. You want to see something sexy? Look at coffee. You can make coffee for this much money, $108 whatever it is, a bushel or whatever they sell it by. That's not what coffee costs. So so that's going to come back, and the reasons were I told these guys at the thing, when you're looking at the coffee report, Brazil just harvested their crops and they're just hitting the market now, and it means a ton of coffee is coming off ships and depressing all the local spot prices. So the spot market is getting killed. And the way the futures work, even though we are buying the July contracts for next year, it doesn't matter. When the spot prices go down, all the contracts go down. But the July contracts allow us to have an entire year in which any sort of disruption to the crops at all is going to be beneficial to us. And all the reports that we're reading say that the Arabica crops, which is what this coffee contract is for Arabica beans, is going to be shy this year by quite a bit, by like 6%. So that's something I want to play. That's exciting to me. Gold and silver at their ridiculous low prices right now are exciting to me. Here's gold, $12.27. Here's silver, $15.50. We haven't seen these prices in ages. Last time silver was $15.50 was last July. And what happened later? It went to $18. But here it is at $15.50, and you're wondering if you can make a couple of bucks on oil. This is freaking $50. I think what is silver? It's like $500 per dime or something like that. It's not 50 per dime. It's 50 per penny. Yes, it's 50 per penny. It's 500 per dime. It's $5,000 for each dollar move up. And I'm way more confident in that thing going up than I am in oil doing anything in either direction. All right, 3 is now asking, and same goes to gold. Gold also. Now, I'm less confident in gold than I am in silver. I think silver is incredibly good by $15.50. In fact, frankly, unfortunately, I did buy gold, and because gold is upside down, I'm kind of like not into buying silver, but I want silver. I'm gonna have to buy some. In fact, let's buy some. Come on, let's make that official. We'll see next week how it goes. But again, you don't expect an immediate turnaround or anything like that, but I'm definitely willing to buy some here. $15.58. That's a shame. I should have done this earlier. All right, so let's. What? Supposed to automatically. His new computer doesn't have any of my things. Auto send with shift click. What does that mean? All right, buy the freaking thing. Thank you. I'm buying another. Okay, so now I got 2 longs at $15.58. If it goes back to here, especially if it goes back to 42, I will certainly buy 2 more and average $15.50. But I'm into that for the long haul. I like that. So here's my 2 silver contracts. So those we'll check in on next week. What else are we doing? You like shoots here, short. Okay. Oh, RDFN. Let's take a look. Oh, how's my Dow doing meanwhile? Dow. Oh, only down 810. All right, good. Just making a little bit of progress. All right, RDFN. I'm not a Redfin fan, frankly, because I competed against these guys. And what are they doing? They got debt offerings, news. Yeah, I used to compete against these guys. I really don't have much respect for their operation. They hired some people I think are real idiots. And frankly, they've never done anything that impressive. So that's my personal opinion on them. As an operation, I don't think they really make any money. Let's take a look. They 370 million in revenues. They're losing money. They've always lost money. Look, these revenues come because they acquire people who also don't make money. I don't know. My attitude about them is they're just in business to be in business. And honestly, and PSW Investments actually, we just partnered in starting a thing that's only in New Jersey that's going to compete with them in New Jersey, New York, and Pennsylvania. But we're going to kick their asses. The stuff they have, their data. And I sold my data company in 2004. Okay, so in 2004, I sold my data company, called AccuSearch at the time, and I had a non-compete, so I never got back into it. But now it's over. And honestly, there's been zero progress in the industry since then. Redfin has done nothing different or new, and there's no innovation been done by anybody in the industry since I left. And all the innovation done in the industry up until that time was done by me. See, literally, you can ask people in the Northeast, in real estate, title business especially, and say, do you know Phil Davis from AccuSearch? And they'll tell you that was some cool shit. We changed the way real estate data was done in the Northeast back in the days. And we were the innovators. But the funny thing is, ever since we sold our stuff and left, nothing changed. and it's 15 years. It's crazy. And Redfin certainly isn't doing. They do things the same old-fashioned way they always did it, and it's not cost-effective. They're not making any money. I mean, if they're worth, God knows what they say they're worth, but whatever they're worth, I should have gotten $1 billion. I'm telling you, I'm sure they're worth $1 billion. Not worth. I don't want to say worth. $2 billion for making no money. We made a couple of $1 million a year in my business. We had a profit. Should have gone public. Holy crap. Back in the day, they still gave you a proper valuation for your business. Like they go like 10 times earnings or something like that. Okay, they didn't give you 1,000 times earnings. So anyway, so that's what I think of that. And yeah, I say absolutely no based on the fact, based on what I do know about their business. And they haven't gone anywhere. They IPO'd here. I guess somebody got a good deal, but they IPO'd here. They went up to here and they've drifted since. It's not for me. Are we cashing an SEO on the LTP? Probably. I haven't gotten to it yet, but as you can see from the first 2 portfolio reviews, I'm looking to cash in pretty much as I possibly can. SEO. Do we have it in the long-term portfolio? Why would we? That doesn't make any sense. We don't have SEO in the long-term portfolio. We have SEO in the short-term or in the options opportunity portfolio, but it's not. It wouldn't make sense in the long-term portfolio. OIH. Do we have OIH? That would be short puts, I guess, and I would say no because there's no reason to cash those out. No, we don't have OIH either. Where are you getting these things from? I know I wanted to have OIH at some point, but I don't see it. So, don't know. But let's take a look, and I'll tell you if I would cash it out. I might have missed the entry at some point, but that's a long, long time ago because I don't think we talked about OIH in ages. I mean, I think they'll be fine. I think as long as oil doesn't fall below 60, I think that there'll be investment coming back, and I think the OIH stocks will do okay. It depends what you have, what your setup is, and so on and so forth. I don't know why, but we don't have any OIH in the LTP. I know I wanted it at some point, but it's not really going anywhere. I think last summer I did want it because it was cheap. Now it's kind of middling, and it's same thing, middle of the channel, not interested. You know, but if you have a spread already and set up, and you make good money at 25, then it's going to be fine, I think. 3 says now real estate commissions are a burden on the transaction. Redfin only charges 1-to-1. Yeah, that's why they make no money. I mean, you know, realtors have to actually do work, especially in the Northeast, and speaking of like, it's an unrealistic. It's like, okay, you know what it's like? It's like saying Uber's only going to charge half price for car rides, and you say to yourself, well, okay, so how are they going to do that exactly? Well, they're not going to pay their drivers. They're going to pay them like $0. You know, maybe tell them, you know, be lucky to get a tip. And they say, well, who's going to actually work for Uber? And where's the long-term benefit? And how are they going to get top-notch people over there? And what are they going to spend on advertising given that? Because the average realtor spends probably 1% advertising the home. Not 1%, $6,000 home, they'll spend $5,000 on ads maybe. They put up signs, they have an open house, they take somebody, you know, you don't value people's time. And every time they go back and forth and setting up the web pages and doing all this stuff, it's a few hundred here and a few hundred there and this and that. It doesn't seem like a big deal, but they're spending time and money. We were looking to buy PSW Investments last year. We were looking to buy into a realty operation in Florida, and and I wanted to. We just couldn't come to a proper agreement with the guys. we weren't seeing head to head on the actual value of the company and so on and so forth. And but it really is all about just hiring cheapest possible people who are willing to show houses. And there's this fantasy to the real estate game where they really underpay everybody in the business. But the broker, for example, so let's say Redfin is the broker in this case. The broker usually takes about 2%. The salesperson will get the 4%. Less expensive, so that's usually 1%. But then they might split it with another broker because there's a listing agent. The listing agent then has the certain amount of commission, and sometimes the listing agent gets 3%, and then the broker and the agent have to split the other 3%, something like that. But then it was up to the listing agent to spend the advertising money. But it's not a joke. They're all about the nickels and pennies in that business. And you can't just randomly say I'm only charging 1 and 1.5%. And I don't know if they mean that's their brokerage fee, or if they mean, because that's conceivably possible if you had a huge volume and you kept your costs low. But as a full fee, if that's what they're charging a homeowner, it's unrealistic. It's stupidly unrealistic. I mean, I'm selling a $500,000 home, and you tell me I'm going to put my best people on it, and it'll be $5,000 to sell it. I'm going to have very low confidence in your ability to sell it compared to somebody who's getting paid $10,000 to $20,000. It's like, what are you really going to do? The guys who sold one of my homes last year, they came over with a photographer. They had a drone guy came and flew over the house and did like a droney thing with showed the whole area and how it looked in different areas, and just fly through the neighborhood and stuff like that, which I thought was very cool. That's what people expect these days if you want to sell a house. So they'll charge 1 to 1.5%, and they'll get all the people who have incredibly crappy homes, but they're not going to get the people who have good homes that want to sell them and put them on the market. Because it's not about whether or not they're getting a commission for these guys. I mean, yeah, I'm going to argue broke it down to 3% if I can, but I'm not 1.5. I wouldn't even have the balls to ask for 1.5. That's just crazy. And I've been in that business for many, many, many years, and I will tell you that's not realistic. But again, none of their business model is realistic. They just keep announcing shit to keep people investing in the company. Here, look, debt offering. So they announced this news. Oh, we're gonna sell things for 1.5%, but give us how much? $125 million. Wait, oh no, I'm sorry. They're selling 3.5 million shares at $20-something. So that's $70 million, right? Is that right? 70? Yeah. So that's $70 million, and then they're getting another 100. So they need $200 million. And why do they need that? How much are they burning? They're burning $15 million a year. That's not much, so that's not bad. What's their balance sheet like? 200. They got $200 million. Why are they complaining? Why are they raising money if they got $200 million? That makes no sense. They don't have too much debt. I mean, it's not that terrible. I mean, I don't understand. If they have $200 million in cash, why would they be? That doesn't make any sense. I mean, they don't list any debt. They're taking on debt. I guess they got some ambitious plan that they're trying to execute. But they have $200 million in the bank, and they're going to issue 3.5 million shares, and there are currently 50 million shares floated. So I guess they're going to dilute you by about what's 3 into 5? It's about 4%. Is that right? No, 6%. Sorry, 6%. So they're going to dilute you by about 6%. So of course the stock's going to go down by 6%. And then you got to hope they're going to do something good with the money. I'll give them something good to do with the money. I can buy my new company. I sell to them for a lot less than $200 million too. It'll make them look. We'll actually make money. We can actually help them make money. I'm going to go talk to those guys. You're right. That's a good idea. So don't tell them I said they're idiots. I'm gonna go ask them. I'm gonna go see if they want to do business. All right. Three says the model is hire the agents instead of commission. Oh, that's a terrible idea. And separate teams to do the listings. App and social media marketing is really good. Yeah, everybody has app and social media marketing. They didn't invent that. Every real estate agent in the world is doing that. The broker I was going to buy is she's sort of, I'm a little pissed about it. She's kind of executing on the plan we discussed. She hired a ton of people. So I said to her, I said, you got 20 empty seats in this office, just fill them. And that's what she did. She filled them. And she filled them with decent people, but not great people. But a lot of what she did, she allowed something she didn't used to allow. She allowed part-time people to come in. So instead of people having a desk, that's their desk, she set up a part of the office. You know, the regulars have desks, but she's got about 15 desks that are flexible desks. So anybody can come sit down and use it. It's got a workstation, and you sign in with Google and you get your own stuff. You know how that works. You sign in with Google and you get your own stuff, and that way you've got your desktop, even though it's on your computer. And that's all these realtors really need. They just need a good place to work and sit down and get phone calls and so on and so forth. So she's providing all these services. This was my idea. Providing all these services to people who are housewives and part-timers. And there's so many people in where she is in Delray Beach in Florida. There's so many people who are retired or semi-retired, years of experience in real estate, and they, more importantly, they all know people. And so for them, if they sell 1 or 2 homes a year, in the tiny amount of time they're going to put in as a realtor, because they say a friend comes down and say, oh, let me help you find a place somewhere. That's what she did. She encouraged people who are semi-retired and part-time-ish to re-up their real estate licenses and come work for her in her office, but only work for her when they feel like it. So now she's got, instead of having 6 or 8 people in the office and 15 empty desks, she now has 6 or 8 people, the same 6 or 8 people in the office supervising probably 50 people who come in on flex time whenever they feel like it, and her sales have doubled. Because each of these people, now you've got people all over town with their ears to the ground looking for a chance to sell a house or to find somebody who wants to buy a house, and talking to their neighbors and saying, oh, let me list your house. And if they do that, the listing goes to Posh Properties, which is the name of the place. It's a brilliant strategy, and she's executing it. It seems to be working. As I said, we didn't agree on valuation, so we didn't invest. But we still might down the road. We're still friendly, but I'm kind of pissed she went through it without doing it with us. But anyway, it's a good strategy, and the reason I liked it was because I wanted to do what you're saying Red Chick's doing, and it's heavily web oriented. We do a lot of social advertising and so on and so forth. But the main point is we're utilizing people and talent that isn't being utilized otherwise. But still, again, that makes sense because we're not paying anybody. Because if you paid all these people, even $30,000 a year, even a couple of $1,000s a month, we'd be broke. Because they don't generate that kind of money. They'll sell 2 homes in the year for maybe $1 million, and the commission on the $1 million is going to be like maybe 5%, 6%, depends on it, maybe $50,000. So you can't pay them a $30,000 salary out of that. That's crazy. And if my commission rate was 1.2%, was $12,000, I'm paying these people $30,000, forget it. So there's no way. What are your expectations for CMG next week? That's interesting. I think we cashed out our CMG, so I'm out of that game. Oh, that's too much. No. That's why we cashed out. That's crazy. Yeah, we cashed out when we got back about here because we were like, that's plenty. Because it's back in its range. And again, back in the range, don't know if it's going to go up or down from there. Oh, why are you moving down the beige book? Well, there you go. That's what I expected. No, the beige book's not out till 2, though. Although I did say I was going to lighten up, right? I'm supposed to lighten up when we get even. Where are we? Dow. Here you go. Oh, I'm still down 450. What do you think? Should I hold out or should I risk the beige book? It's not going to say anything devastating. I think I'll hold out. It looks like it tested 2150 and bounced off it, so you know we'll see what happens. Oh, my stove is making money, I think. Why doesn't it tell me? Ugh, I gotta fix this whole thing. It's so annoying. That, can I get rid of that? No. Oh, wait, auto send. Definitely want that. Gotta fix a lot of stuff on this thing. What's this supposed to be? It's supposed to be RTY. Now, as I said, I averaged into 25, 150. I started down about 25, 1 when I started buying stuff. So just because I averaged to 25, 147 doesn't mean I have to only lighten up there. I lighten up when I think it's not going to keep going down. But I think it's going to keep going down, but I got to keep my eye on the other indexes and see how they're behaving. If they start going green on me, I should lighten up. Even though I still have a small loss when I lighten up, that's not the point. The point is that the only reason I bought more shares was to lighten up, and whether I fully lightened up or not, I still mitigated my losses. So now look, I'm so close, I should really get off, right? I have 8. I certainly don't want it to go up at all. So anything down, let's see, what I'm doing is I'm watching these lines. If it pops up even a little bit, see there, I'm not happy, and here I'm going to trigger. If we go up another point, I'm out. Not out, I'm back to 4. I'll take 4 into the beige book. I don't want to take 8 into the beige book if I can avoid it. Oh, so, oh, you bastard. I said to auto send it. Oh, no, I said auto send on that one. Oh, man. Auto send, that's the, you got to click that auto send thing, otherwise it doesn't do it. 54, oh, that's a good break. 52. Nope. All right. All right, so now I'm happy because now I'm back to 4, and even if it pops all the way back to 25.2, I'll just double down, and my average will be, I don't even know. I mean, my average will be whatever it is, but the point is I'm down 200 bucks on 4, which is 10 points. So my average is about probably 46, 47 range. And so if it goes up 50 points from here, I'll be down a couple of $1,000, but then I can double down, and my average will be in like the 70s. So that's fine. I'll be happy with that average. I'll be happy if it just goes straight down, of course, but at the moment, that's where I am. So what when you focus on, if you want to figure out, I'm down 4 contracts, almost 400 bucks. So I must be down then 20 points. So 20 points at $5 per point is going to be down 100 bucks. I'm down a bit less than 20 points at 57.58. And that's how you figure out your average. So I take 20 points off that. So I'm about, figure 140 or something. The 25, 140 basically is probably my average. Why did it say 47 before? Because I had 8, but I took a loss on 4 of them, and now my average is actually lower on the short. My average is lower than it was. So yeah, I'm glad I did that because now it's popping, even though there's still no beige book yet. And there's just people, front running the book and trying to figure out what's going to happen. So we'll see. So now let's take a look for the beige book. We'll see what's going on. Beige book. Fed beige book. Oh, not ready yet. So the most important point I want to make about that, it's not the market's fault that my average was below the line I thought that we would get to. I thought we'd get to 2150. I had not managed to get my average to 2150. That's no reason for me not to take the money. I didn't get all of the gain that I wanted off of that trade, but I got most of it. Oh, wait. Oh, that's earlier. I already made that money. This morning I made some money on the Russell. I thought I was making money now. I'm like, I forgot about that. So keeping in my head that I have an average of 40, it's not really going to be worth it for me to add anything until it's like at 80. If I add one at 80, that'll bring my average up to 50. That's worth it. And then I'll decide if I want to add any more. But unless it's 25, 180, I'm not going to bother adding anything. But everybody's heading up now. You know, it's interesting because the Dow itself, the actual index, is not heading up. It's plus 64, which is where it was when it was when the futures were at 50. So the futures have gained 12 points, even though the index itself hasn't actually moved up. So probably that's going to evaporate. Yeah, but you know, none of it matters. Well, watch. I mean, it's going to be funny. Watch how fast it goes, and good luck going through this beige book in the time that this thing's going to react. So here it is. Hopefully it'll be out now. We're going to refresh. Nope. Nope. The actual Dow is going down. And this is going up. That's kind of funny. The Dow is now plus 62, and this thing's going higher. There's a bit of a discrepancy going on at the moment. Now it's 64, 65. Oh, Fed economy growing mostly in most districts. No, modestly. Prices and wages are up modestly in all areas. No shit. See, tell us something we don't know. I'm just reading the summary off of CNBC. 67, 68. Some areas showed an uptick in inflation. Manufacturers are concerned about tariffs. Wow, really insightful, right? Your tax dollars at work here. Steel production increased modestly. Somebody has some huge iron ore. BHP had really great iron ore production. So somebody's making steel. Maybe it's not us, but somebody's into it. Dow is now 71 points. So it's actually the futures have made a good call there. They're ahead of the Dow. Tariffs caused higher prices and supply disruptions. Nope, that's all they have to say apparently. Okay. Yes, back to economy growing modestly in most districts. All right, so let's take a look for ourselves and see what it says. Page book, right, refresh. There it is. All right, economic activity continues to expand. 10 of 12 reporting moderate or modest growth. Record high stock market, moderate or modest growth. Outliers, Dallas, which reported strong growth. The outlier is strong, that's interesting. Driven by energy, we know that. St. Louis is slight, so that kind of balanced out Dallas. Manufacturers expressed concerns about tariffs, higher prices, supply disruptions to the trade policies, labor markets tight, inability to find workers, constraining growth. These are not, again, record high stock market. This is not what you expect to read in a record high stock market. This is like saying we're definitely going to win the Super Bowl, but the kicker has a broken leg and the quarterback's got a sprained wrist and the lineman has a stomach flu and 4 of the receivers are on vacation and blah, you know, but it's looking good. Put all your money on this. You know, it's just not giving me a lot of confidence. Consumer spending was up. Now it is up. Consumer spending is up and debt is rising faster than spending. The problem is consumers are confident based on the bullshit that the government and the media is putting out, and they're spending money they don't have in anticipation of raises and stuff they're not getting. Context for the higher input prices, shrinking margins. Oh, wow, that's good stuff. Higher input prices and shrinking margins in a record high stock market. Six districts, that's out of 12, I think, right? Yeah, 12. So half the districts, trucking capacity. Oh, and trucking capacity is an issue. With a shortage of drivers. No problem, right? Record high stock market, pay more, quick. Pay 50 times earnings, 50 times current earnings. That means that there's supposed to be some huge growth ahead in a constrained market with tight labor and shrinking margins. Good luck. Several districts reported concerns of existing home sales, which were down 12% today, but we're not overly concerned about rising rates. Commercial real estate was largely unchanged. Now, this is collected on or before July 9th. They don't know about today's report in this thing. Employment continued to rise, modest pace, labor markets were tight, difficulty following qualified labor. Oh, and by the way, I was at Burger King the other day, and because it was next to the AT&T store, I don't really go to Burger King much, but I don't go to any of the as a typical fast food, I don't go to like fast food places a lot. And I stood online for, oh God, I think I walked in there, 5 people in line ahead of me. I'm like, okay, because I wanted to get they have Slurpees for their frozen Cokes. So I wanted to get a frozen Coke because it was hot and I wanted to have something cold. So I walked across from the AT&T store, walked into Burger King, and 5 people ahead of me. Must have taken at least 20 minutes before I got to the counter. The person serving me was totally incompetent. Literally a Slurpee, like it's self-serve at 7-Eleven. This guy took probably 3-4 minutes to give me a Slurpee. If I was standing in 7-Eleven next to the Slurpee machine, and you said, I'd like a Slurpee, and you handed me money, you would have a Slurpee in 30 seconds. I don't know what they're doing there, but that's the problem. When the labor market gets tight, you're forced to hire less and less competent people. And it's not just about the guy who's assembling the Tesla Model S. It's about the guy who serves the Tesla Model S guy his lunch. And the guy who cleans it, and the guy who does the wheel cleanings, and the guy who does the janitorial work in the Tesla place because the bathroom breaks and nobody shows up to fix it, and everybody has to walk across to, has to walk 5 minutes over to the other bathroom on the other side of the factory. That's how things break down. Okay, I've been a consultant I've been a consultant in business for many years. This is what happens. This is what, when you're in a wage-constrained environment, when you're in a labor-constrained environment, it's not, people don't think of it the right way. They worry about employment costs, but it's not about employment costs. It's about incompetent people at various levels of jobs who shouldn't be working those jobs, but because you're so tight on labor and you can't get good people, you've got a lot of bad people doing jobs, and it causes a breakdown in quality, and it causes a breakdown in efficiency and breakdowns in time, and it grinds the economy to a halt. That's the real danger to a constrained labor environment. All right, so for homework, I want everybody to think about that next week. And I want to hear everybody's stories, okay? I want to hear what you think. Pay attention in your everyday life and think about in what way you're being impacted by a too tight job market. It's interesting because when you start thinking about it, you realize like, hey, I'm being less productive because I had to wait for this, or this person didn't do this right, and this person didn't do their job right. And it just cascades all the way through society, and it starts hitting it. But it doesn't hit it quickly. You'll see it in the next quarter and the quarter after that, and you'll see the sort of cascading effect in the economy that brings it down. And how do you fix the labor shortages? Well, one way you fix the labor shortages is by allowing more immigrants into the country. Not going to happen, right? We're kicking them out. We're not putting them in, we're kicking them out. Another way, education. No, we're not doing that either. We're dismantling education. So you either create more educated workforce and better people, which means you put money into not just training but retraining workers. So people who are unemployed should be able to go and get training to do other jobs and do them properly. That would make everything more efficient. But no, we don't do that either. And we're not training our children to be productive in the labor force, and we're not making incentives. You're forcing people to go off welfare and get jobs, regardless of whether or not they're capable of doing the job, regardless of whether or not they're physically able to do the jobs. By forcing these welfare people to work, all you're doing is shoving poor quality people into the labor force. When the real way to address the job is to open up the gates and allow immigrants in who are qualified immigrants. And you say, if you have these skills, we want you in America, please come. But you can't do it when your environment, even if you do that, it can't be an environment where the president seems like a psychotic and randomly kicks people out of the country or suddenly turns on certain races and nationalities, because a smart person from another country is going to say, I'm not going there. You sure as shit are not getting Muslim doctors applying to work here, Muslim nurses applying to work in America, or Muslim truck drivers. All right, and you can be as prejudiced as you want. You say, I don't want any Muslim truck drivers, whatever you want to say. But the bottom line is, you're not getting these people. They're not coming here. They're going to other countries that need labor and making them more competitive, not than us. And we are not filling the gap. And it will hurt us in the long term. It's a bad policy. IT professionals, truck drivers, blah, blah, blah. Okay, let's see, IT workers from foreign countries who we disparage. So they're not going to come here. They can work anywhere. They don't need to work here. A good IT worker is just as much in demand in China as they are here. I mean, hell, Putin just had 25 guys indicted. He needs replacements. Districts indicated labor shortages constraining growth. All right. Firms are adding work hours. Yes, to make the people you have work more hours. That's a short-term fix. It's not a long-term fix. Retention efforts get expensive. Partnering with local schools. The businesses have to do it because the schools aren't doing it themselves. Converting temporary workers to permanent also, as well as raising compensation. So all this is impacting their margins. They have to do all this stuff to get people. They can't just advertise for jobs anymore. Soon they're going to have to hire headhunters again. It's been a lot of years since headhunters have had good jobs. But headhunting is going to come back. It says on balance, wage increases were modest to moderate. That's why they're having trouble finding people. There are people you just got to pay them. But that's when all hell breaks loose, because then once people start paying to get good people, then all of a sudden everybody's up for bids and people realize they can shift jobs. I think I've said this to you guys before. When I used to work in the 70s and 80s, if you didn't get a 10% raise, you'd quit. You'd be like, screw you, I'm going to go get another job then. It's like, you expected a 10% raise every single year. And if you didn't get one, you say, well, I'll quit and I'll go open the paper up and see who's paying me at least 10% more than I'm getting now. And you didn't even have to know what you were doing. You could just apply for a job. They would train you in almost anything. There'd be ads all over, pay me, pay this, pay that, pay that. Because they needed laborers. They had a problem. And that's not good for the economy. It's not good for the corporations. It's good for people, not good for companies. All right, so prices increase all districts, modest to moderate. Report shows upticks in several districts. Key inputs further, fuel, construction materials, metals. Wow. Those are pretty key, including fuel, construction materials, freight, and metal. What didn't increase? Labor's increased. We already know that, so I'm not quite sure. That's pretty funny. A few districts describe these price pressures as elevated or strong. Oh no, elevated or strong, record high prices. Let's pay record high prices to the company that has elevated or strong pricing pressure on them. Tariffs are contributing to the, now of course the company selling it is good, the miners and things like that, the people selling the stuff is good, not the people who have to buy it. Tariffs contribute, so keep that in mind, fuel, construction materials, freight, and metals. Tariffs contributed to increases for metals and lumber, and that doesn't do metal and lumber. That's why miners not doing good. Tariffs on metals and lumber doesn't help the guy producing the metal and lumber. It's just a tax that Trump collects on his product. So he then has price pressure to be lower because the tax makes it higher. So in other words, I'm a logger and I sell a tree for $100. Trump puts a $25 tax on it, now it's $125 to the guy who's buying it. So that guy comes to me, my customer goes, hey, I can't pay $125 for this tree. I was paying $100. And I'm like, well, I can't sell it to you for 75. And so you guys have to work it out. Now, with the 25% tax, obviously I can sell it to 80, and the 80 plus 25% is 75. So there's a little bit of a play in there. But either way, and then so let's say me and the customer end up determining I'll sell it to 90, and we're kind of splitting the damage on the thing. But meanwhile, what happens? I'm in pain because I make less money. My customer's in pain because he makes less money. And who's really in pain? The consumer. He's got to pay all the difference. That's how you can screw everybody with these trade policies. And that's why they're such moronic ideas. That's why they were abandoned in the 1930s and we thought they were never going to come back. It takes a guy who actually slept through business school to come up with a plan like this. The extent of pass-through from the input to consumers remain moderate. So the consumers are not picking up the prices. That means the companies are taking a hit. Okay, you know, guys, it's math. So the tree was $100, and the logger made this much money, and the guy and the Home Depot made this much money cutting up the tree for lumber, whatever, you know, I mean, however it works. So I'm just making an example. It doesn't matter how it actually works. So the tree was $100, and the logger made $20, let's say, profit, and you know, so you got to pay all his guys to cut the tree down and move the tree and all that. And then he takes it to Home Depot and they pay him $100, and he's got his 20% margin. And not 20, he makes 25% because his net cost on the tree was 80. He makes 25%. Now Home Depot will mark that tree up and cut up the lumber and do their work, which is their, so they're saying they took it in for $100. They cut it up and process it, and they sell it for maybe $150. You know, in the wood form, in the form of wood that you get. Now Trump comes along and puts a 25% tariff on the wood at the point of the dealer, at the point of the lumber guy selling to Home Depot, because that's where the 25% tariff comes in for bringing it into the country. So now, even if the guy can't back down to 80, he makes no money. He says, not any point even selling it to you if you're only going to pay him 80. But he says, I got to get 90. So Home Depot goes, fine, 90. That guy's now making 50% less profit. He just took away half his profit. Home Depot now has a cost of 90 plus 25% is $115, let's say, 112, whatever it works out to. And so now they're up there, their cost is now up $12. They're going to pass that on to the consumer as much as they can. But they can't pass it all down because the consumers are fairly inflexible because they're freaking broke. So now Home Depot, who paid 90 for a tree that they used to pay, who didn't pay 90, they paid 112, are only able to pass on maybe $10 of that increase, and they're taking a $250 hit on their $25. So they're taking a 10% hit in profit. So the lumber guy's taking a hit in profit, Home Depot takes a hit in profit, and the consumer is paying a few bucks more for the lumber. He's taking a hit in his disposable income. Lose, lose, lose. The worst economic policy possible is tariffs. It hurts everybody in the chain. So consumer prices, so this will change at some point. The money will get passed on to the consumers more. Movement in agricultural commodities mixed and against the pressure. Pricing pressure expected to intensify moving forward in some districts, while others in the outlook for stable prices, blah, blah, blah. And then it goes to districts. It used to be so much better. It used to go through each activity in great detail, and then it went to the districts. Now it's like terrible. See, it used to do this. See, employment wages, it used to have an overview of all these, of employment wages, prices, retail, tourism, manufacturing. That it used to do for the whole country. Now it doesn't do that. Now it breaks each one down by district, which makes it, effectively unreadable. It's really a shame. Anyway, so bottom line, still like my short position. Nothing here improved, and we are now down here. Profit. Oh, not profit. I'm sorry. It's better than it was anyway. So we'll see what happens. Russell's heading up though. The Russell's happy. Questions? Phil, you suggested BJO 40. That's a terrible spread. That BJO really collapsed. Is it good for a new spread? No. The coffee ETF is terrible. I love the coffee play, but that ETF is deteriorating so quickly. I worry about whether it's good or not. Any silver for non-futures folks? In that case, if silver wheaton comes down, I like them. WPM, wheaton precious metals. Terrible service at restaurant. Yep, that's another one, right? That's hitting everybody. Yeah, terrible service at restaurants. Imagine what the dishwashers are like. Imagine trying to find people to wash dishes in the back. And God knows what's going on at your food processing. You don't even want to think about that. Imagine the farmers in the Midwest having to find people who are willing to like shovel hog crap and do whatever, and not only that, but the guys have to slaughter the hogs and chop them up and put them into packages and blah blah blah, and all the packers and the meat packers and stuff like that. These are the hard jobs to fill the best of times. People don't want to do that stuff. And you get lower quality people in there, and they're less sanitary people, and you don't have the overseers to watch everything. And oh my God, I don't want to think about that. I eat out a lot. I don't want to think about that kind of stuff. It's not good though. It's really a shame. And yeah, it's true. In a bad economy, rich people we super benefit from stuff like that because you get a lot of quality people doing menial labor. When there's a lot of unemployment, you get really, you guys are Ivy League graduates, like taking your order at a restaurant. It's like, okay, good, I'm gonna get everything done right. I'm gonna get my food back just the way I want it. You got the chef has like 5 people working as assistants in the back, taking low wages because they're happy to have any kind of job. All this stuff is going on, all these extra help and so on and so forth. That's all gone now. You can't get away with like having cheap assistants in a restaurant. You can't get away with having 3 guys scrub the floors for $5 an hour. With one guy for $15 an hour, that means the floor gets 1/3 scrubbed. So very interesting. Where did I say I was going to double down at 80? Not double down, but I was going to add some at 80. All right, I'm going to ignore it though, so it's not worth watching. All right, what else? See, I'm going to cut this at 2:30 because I got to get ready for this BNN thing. We should look at the options opportunity portfolio then. All right, enough of the futures. It'll be what it'll be. Not a good day to trade them. Where did I do my review? And on the bigger picture, I wrote this morning, you got to remember we're in a rising rate environment. There's no getting out of that. And we're massively in debt. State debt, 1.2 trillion, local debt, 1.2 trillion. These are 2 different things. Unfunded pensions, 6.2 trillion. The reason GE is in the tanks and can't get out is because of unfunded pensions. And honestly, theirs not too bad. I did the math on them. This is all about their unfunded pensions. Yet we're giving America a complete pass on the same thing. $6.2 trillion of unfunded pensions, and we only collect $3 trillion a year in taxes. And that's $1 trillion deficit when we're collecting $3 trillion in taxes. So there's no possible way to pay that off. All right. Aging. I'm looking for like one of those bubbly charts that shows you when it hits. Maybe that. Okay. 65 plus, right? Oh, that's Japan. That's not us. I want a chart like that for us. Shit. Aging U.S. population. Oh, here you go. Population over 65. Okay. You are here. You're here with 40 million people at 65. You will be here with 80, 90, almost 90 million people. In fact, you know what? They're going to cure, or not cure, they may cure cancer, but they'll certainly make improvements in cancer and a lot of other stuff. This number is going to be way up here. People are not going to die. That's a big problem. You want to talk about a problem nobody talks about? This is a way bigger problem than anybody realizes, because not as many people are going to die as they think. If you cured cancer, it would immediately spike this thing up like crazy. Even improvements, though, are going to make drastic changes. They're going to be able to 3D print organs, liver, kidneys, maybe lungs, heart. So when shit wears out, they're going to make a new one for you. I don't know who's going to pay for it, but that's what's going to happen. If you're rich, you're going to be able to live a very, very long time. All this stuff is like, look, 2000, did a 3D printer exist? No. No, in 2010, they weren't really 3D printers. It was just sort of like barely started in 2010. Here we are now. 3D printers are like boring. Nobody even talks about them anymore. But you got gene editing and things like that, and splicing and stuff going on. You're going to have all sorts of amazing stuff. Because let's remember, in 1980, when I went to college, that's when the 1984 Macintosh, right? 1984 Macintosh computer. Here we are. It's a lot later. It's 30 years later. 30 years later, the watch you wear, the iWatch that you wear, is 10 times more powerful than that Macintosh computer, and 1/10 the price. And medical science is just like electronic science. It's going to double and quadruple and expand and get cheaper, and it will be more accessible, and it's going to cause a complete population disaster. Unintentionally, but what is the end result of helping people to live longer? A lot more old people. And it'll take a long time before, like Japan, they stop having kids. They're like, oh well, everybody lives so long, we don't have kids anymore. That's why Japan's thing is easing off, because they basically, it's been happening for so long to them that the average family only has one kid. They're like China, except voluntary. And China is trying to solve their aging population by taking away the one-child thing and having more kids. Japan hasn't gone that way. Japan's encouraging people to have kids, but they can't get them to do it. It's too freaking expensive. Raising a kid, college and stuff, too expensive. Anyway, where was it? Oh yeah. So right now, we can't afford Social Security and Medicare, and we're here. Where are we going to be? This is only 20 years away. Where are we going to be in 20 years when it's double? And doubling in 20 years means on average 5% more problem per year. Who's fixing this? That's without breakthroughs. That's just a normal curve based on the population now as it's aging and as the boomers move in. I'm not even on this. I'm 55. I'm the tail end of the baby boomers. I was born in 1963. This is the people causing all the problems. So I'm 55, and by here I'll be 65. I'll be part of the problem here. I'll be right here. I'll be in that problem zone. Then I move to green, and then I move to purple. I'll be in this problem zone. But the real problem is that any kind of advances in medicine, and this thing's going to go up by 10 million, and this one's going to go up by 10 million, and it's going to go up by 5 million, and that's freaking 25 million higher than estimated. And we only have 40 million people now on Social Security. Can you imagine adding 25 million more unplanned people when we're already 6.5 trillion behind and we're $1 trillion a year in debt? It's a huge, massive disaster in progress, and no one is taking it seriously. And it's true, because we've been talking about it for a long time. Talked about it in the 1990s, talked about it in 2000, talked about it then we have that's what happened. We had that crisis and everybody forgot all about this bullshit. We didn't have time to worry about that. We were worried about like eating. And then now we're starting to like look at it a little bit again. People starting to worry about this stuff. But what are we doing instead? We're piling on the debt. We're having massive tax cuts. We got Social Security, Medicare. It's not a matter of defunding it or cutting it. You can't cut benefits enough to pay this many people. You can't pay the people we have now. So by the time I'm collecting Social Security here, there's going to be 20 million, 50, almost 50% more people, 40%, let's say 40% more people who want it than want it now, or eligible than are eligible now. That's not sustainable. By no stretch of the imagination is that sustainable, yet we're doing nothing about it. We're ignoring it. We're like freaking irresponsible children. And it is going to be a disaster. And one day people are going to realize it, but hopefully not today. Anyway, all right. Oh, now it's 2:30 here. So I was going to say we have the options opportunity portfolio, which we went over. Hello, why can't I click on this? What are you doing? Are you guys still there? Guys, can you hear me still? Because I felt like something went wrong on my screen. Yes, no, hello? Oh, yes, thanks, Jeff. Appreciate that. Good name. All right, did you see me the whole time? No, well, now I don't know what you're saying yes to. All right, don't worry about it. All right, so anyway, because my screen did something weird, like I froze, so I didn't know what happened. All right, anyway, so we're good. And we were talking about I know, because I tried to click on this and it didn't work. I don't know why, it like suddenly went dead. So the options opportunity portfolio has gained 2% since we reviewed it. It's pretty good. In the review, we talked about, oh, I didn't get there. Okay, here's the important thing in the review. I'll just go over it really quickly. There's plenty of good trades here and stuff. Notice in each trade, I'm doing what I like to do in a mid-year review is We talk about the trade. Oh, is it good? Are we worried about it? How much are we going to make if we leave it alone? So this Apple spread currently is minus 23.50 in the portfolio. It means because it's 470 on a short put, I've got 5, that's 23.50. So when they expire worthless, if they expire worthless, I make 23.50. It's not hard to calculate. When I'm calculating these spreads, this spread is 11,500 minus 2,200 is $9,300, and it's 40 of a $15 spread, so it's $60,000 spread. And you calculate how much you're going to make if it hits the full. Although I didn't do that with SQQ because I said realistically we're going to hit $18 and that would be $32,000. I'm not saying we're going to go all the way to 25. I said I would buy back those $25 short calls if I could, but I'm not going to pay 55 cents for a call that is 100% out of the money. 100%. Now, the NASDAQ has to fall 30% for SQ2 to go up 100% because it's a 3 times ETF. I'm not betting on that. I don't understand anybody who is betting on that, but I'm sure I'm going to buy. I'm not going to give this guy 55 cents to avoid that happening. I don't think that's going to happen. So unfortunately, that constrains me a little bit, but I'm happy with my $10 calls. Those are $2.50 in the money. So anyway, with each position, we're going through it. What do we expect to make? What do we expect to lose? This is a hedge, so we expect to lose money. This is a hedge. I expect to lose money, not make money. FTR, we expect to make money. Talking about, here I'm talking about every position. What are we in it for? What do we think it's going to do? What do we think we're going to make? And then you decide if it's worth keeping or not. And you got to do this with every position in your portfolio. You know, don't wait for me to do it. You guys should be doing this on a regular basis with your own portfolios. You've got to know what you're doing. You've got to have a plan, and you've got to stick with it. Now, in the options opportunity portfolio, oh, this is the options opportunity portfolio. A few months ago, we were up about 10%. 50, I think we were 15% at the time, maybe, because the market was toppy, and I decided it was and also we had $144,000 of potential gains in the portfolio, and I decided that since we were on track to make that much money, we could afford to gamble on some stuff. Now, unfortunately, none of our gambles worked. So our gambles were. Is this the OLP? I'm confused. Oh, yeah, it is. All right. Our gambles were putting more money into FTR, putting money, a decent bet on GE. I wouldn't call GNC a gamble. HMNY, huge gamble. A Northern Dynasty, huge gamble. All of those gambles so far. Now, okay, let's be fair. VRX was a gamble that paid off, and so was Boots. We just did that. That wasn't a gamble. That was obvious, I thought. Those are our gambles. I'd say the other ones aren't really gambles. I wouldn't say they're gambles. So anyway, so we took a few positions. We gambled. Those are down probably $20,000. And now, how do I know they're down $20,000? I mean, aside from the fact that I did the math and I can see that they're down $20,000, that's also reflected in the fact that we are now only projecting about $125,000 in net gains. So we were looking to make $140-something thousand, but now we're going to make $125. Why? Because the positions we gambled on have hit us, and we're also not projecting any profits. In other words, I'm not on Northern Dynasty saying I'm going to make any money. If you look at my NAK position, in fact, here, so none of our gambles are working. This one's down $12,000. That's where all our profits went. Blah, 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 blah. Because it's not so much that we were ahead as far as cash when we took these gambles. It's that the portfolio was on track to make $140,000. And of that $140,000, I said, okay, so let's take a few positions where we'll gamble, which can double where we're at. Here's another $100,000. Now, again, none of them worked so far, but we didn't expect them to work right away. They are gambles. We knew they were gambles when we went into them. They are affordable gambles because even with all that, the portfolio is up 10%. And that's after losing like 20-something thousand dollars on these gambles. And we didn't lose it, they're down. We still own the positions. But it's because we have a plan and because we know how much money we have to spend that we can afford to do that. And also because of that, since it's not working, I went through the portfolio and we took off $43,000 worth of profits, which brings us back to being more than half cash. So now, even though we have half cash in the portfolio, we are still looking to make $125,000 with half of our buying power remaining. That means we can take more opportunistic plays. But they're going to be plays like GIS, which we just added to the money to our portfolio. They're going to be good conservative plays because our fund plays aren't working. So if your fund plays aren't working, you don't make more fund plays, you go back to what makes you the money. You get back to the grindstone and put in those plays that have a high probability of making a little bit of money. It's fun to make a lot of money. It's worth a gamble once in a while if it's a sensible gamble. But if the gamble doesn't work out, you don't keep gambling. You say, okay, I had my fun, I'm done. I always tell people, you know, I'm a pretty good poker player. And I like to play cash games. And usually what I'll do, and, you know, obviously I make and lose thousands of dollars at a time in 5 minutes on options contracts, on a future contracts. So I'm not shy about losing money at a poker table, but it's not how I like to play. You know why? Because I'll play the options markets and I'll play the futures because I know how to make money there. I'm a professional. I'm not a professional poker player. I hope to be one day, but I'm not now. And so I limit. So what do I do? Because I'm not 100% confident in my poker the way I am in my trading. I limit my losses. And how do I limit my losses? I play a $1-2 table. As good as I am, I still will play a $1-2 table. I'll take $200 cash. And if I lose it, I quit for the day. So here's my rules. If I make money, I buy myself a nice dinner. You know, when I'm in Vegas, Atlantic City, or wherever I am. But if I make money, I buy myself a nice dinner. And it's paid for with the money I made. If I lose money, I buy myself a cheap dinner. Since my average dinners are going to be $50, $60, $100, I'm softening the blow considerably by going to get a pizza if I lose money. That way I didn't lose my dinner. That way I'm saving my money on dinner instead. I win more often than I lose. I lose no more than $200 per time. I easily sometimes win $500, $1,000, sometimes $2,000. It's amazing how much money you can win starting with $200 in a cash poker game. You know, if you got 10 people at the table and people go all in and stuff like that, and you double up, then you double up again, and somebody else goes all in. You know, you sit there long enough and you make a lot of money. But you know, so I just like to play friendly, fun games because I'm practicing, I'm learning, I'm putting in my 10,000 hours playing poker so I can get good enough to sit down at the really big tables with the high rolling guys and be competitive there. But I'm not under some illusion that I'm competitive with everybody like that. You know, I'm good for normal people. I'm not good for the World Series of Poker kind of good. But the point is if you're not 100% sure about if you're going to win or lose something, then it comes down to good money management. And good money management is playing a game that I can more than double up very easily, where I can't lose more than my initial bet of $200, and the initial bet of $200 means pretty much nothing to me when I sit down there. And that's managing your money. So in a week in Atlantic City, if I'm terrible, and I lose $200 every single day, I lose $1,000. Doesn't change my life one bit. Sometimes I come home from Atlantic City with $5,000. Doesn't change my life, but it's fun. It's nice. So I enjoy it, I'm learning, I'm getting better, I'm polishing my skills. Same thing goes for trading. But it only works if you know how much you're going to risk and you know how much you're going to win and you make sure you're on track. And if you're not on track, you do something about it. And that's what all these positions are about. And I know some people are new here, and it's very important. And ask, in chat and stuff, ask about trades if you're thinking of getting into them. But it's very simple. In saying here, what do we expect to make? What is the trade now? This one is 37.75. Great for a new trade because it's going to make $10,000 more dollars. That's 300%. It's going to make 300% from where it is now. That's FNSR. Is FNSR risky? No, not really. It's actually very cheap, and it's not looking as downtrodden as it was. And somebody just wrote up a good report on optic people today. So they're just breaking back up. So now when we picked them up, they were down here. Now they're just coming back up to their 50-day move, or 200. I'm sorry, the 200-day moving average. Of course, they're consolidating below the 200-day moving average. That's what they're doing. They hit the 200, they're consolidating. They're going to hit the 50. They'll bounce up. You'll get one of those triangle squeezy thing patterns, and it'll break up. You can say maybe it won't, but that's when we have to then watch earnings and make sure they're on track. But I love these stocks. They're a $2 billion company. They have earnings in September, so it's going to be a while before you see it. They are capable of making money. They made $250 million here, but that's because they had a tax credit. See, when you see, oh, by the way, that's important. When you see that, when you see an 86, it doesn't matter why they have a tax credit. The point is they had an $86 million tax credit. Usually, they would have paid what? 20% of that, at least 30 something. They should have paid $30 million in taxes. Instead, they had a credit. So you have to subtract 100 million at least from this number. So 150 million realistically is what they make. Analysis wise, they're good for 60 cents a share, $1 a share. There's a lot of agreement there. There's not, I mean, people are seeing $2. The low estimate is 115, and it's a $17 share. So they're trading below 20 times earnings. And I like the company, and I like the space. So I like this trade. And with FNSR, they're at $18, and our trade, not an ambitious trade. We have the $13 calls. They're at 18. We sold the $17 puts. We have the $13 calls. We sold the $20 calls. At 18 bucks, what do we make? 20 times 5 is $10,000. What's the net of this spread right now? So the price it's at now, it's a $10,000 spread, and you can buy it for 14 minus 7 minus 3 is about $4,000. In the money, $10,000 right now, not looking that risky. It's crazy that you can buy this thing. Sometimes these option prices, you're like, how is it possible that I can do this? But that's what it is. All right, so I definitely urge you guys to study these portfolios. I'm not doing it for my health. In fact, I'm exhausted. But study these things and go over the reviews and look at what we're doing and think about that for new trades. And also, though, get in the habit of doing the same thing yourself. Go over your trades every month. Make sure they're still right for your portfolio. Make sure you don't have money tied up in a position that you don't need to. Who would be taken off the table? THC, we took off the table. It's an $8 spread, and we have 15 of them, right? So that's $12,000 at best, assuming the puts expire worthless. The best we can do is collect $12,000 on this spread. Currently, 35 minus 25 is $10,000, minus 800 is $11,000. So currently, it's about $8,000. I mean, sorry, it's about $11,000 out of $12,000. So between now and 2020, I can turn $11,000 into $12,000, make $1,000 bucks, 10%. It's not worth keeping. I'm not going to wait 18 months to make 10% and tie up $11,000. That's crazy. So you take it off the table. And you've got to look at your positions like that, because otherwise it's just like having a bad employee. A position like this is like a bad employee. It's not productive. It looks pretty in your portfolio. You have this wonderful gain and look like it's a genius, but that's not productive. I want my portfolio to be full of positions that aren't working yet. That's where we make the money. And this thing should be up. Actually, you know what? We're probably even to where we were last month because of this the VRX position. They changed their symbol and the new ones aren't in yet. So this will zero down. So we have effectively, even though this is a 7 times 10 is a $7,000 spread, so you know at full price, and they were in the money basically. So instead of showing 7,000 or really let's say 4,000 to the bottom line, it shows 0. So we're being ripped off by $4,000. So we should be up right about 15%. Because it's all zeroed out and we should have money. It's not giving us the full value of that position. So that's the thing. You've got to know what every position is doing, and also you have to know that you have to say, "Gee, is my portfolio underperforming?" No, it's not, because this position is showing 0. That's a reason that the portfolio looks like it's underperforming. So I shouldn't go and run and do anything drastic. All right. Well, that was longer than I intended it to be. I'm gonna have to run and get ready for my show. And that'll be it for this week. All right. Thanks everybody for coming. We'll do it again next week. All right. Take care.